Hello everyone, in this video today we're going to be going through a statement of cash flows practice problem. Now this is going to be a comprehensive example of statement of cash flows, going to include a lot of items that you potentially would need to know, and so it's very long, but it is purposefully intended to be long so that way we see a wide range of different things, okay, that we might need to know, okay. So we have ABC Company is a company that makes video games in the Battle Royale genre. ABC has the following balance sheet data available for the years ended December 31, 2017 and December 31 of 2018. Okay, so this is just the first page. It's a little bit blank, but if we flip the page, okay, we will see that we have all this balance sheet data for both 2017 and then 2018. We're given all the accounts, and then we're given basically the December 31, 2017 balances, and then the December 31, 2018 balances. Okay, and so why are we given all this information? Well, we're given this information because it's going to be helpful for us when we actually prepare the statement of cash flows. Okay, so what we want to do is just, get a picture of, okay, this is the information we're given, and then we want to come back to this once we have read through the rest of the problem, but just to keep in mind, okay, we're going to need to use this information. Okay, so then we want to look at the additional data, and then we're going to start working through the problem. We're going to go back to that page. We're going to use that page a lot, but let's just read through these facts so we can get moving. Additional data is as follows. ABC's net income was $53,500 for 2018. The company declared and paid $10,000 in dividends. Okay. ABC purchased $2,000 of its own stock back from stockholders. That would be treasury stock. Okay. If we remember from previous videos, when a company repurchases its stock from stockholders, this is called treasury stock. Okay. Then the firm issued $30,000 of stock in exchange for a piece of land. This is actually going to be non-cash financing and investing, that section at the bottom, okay? Because again, it's, the definition of non-cash financing investing, what goes in there? Well, it's items that would generally be included in either financing or investing sections of the statement of cash flows. However, there's no actual cash exchanged, right? So here it's common stock for land, right? So there's no cash going in or out, okay? So we can't necessarily definitively say it's one or the other. So we just say, okay, there's no cash involved, we'll put it in its own section. Now ABC sells a piece of equipment with an initial book value of $30,000 and $5,000 of accumulated depreciation for $26,000, okay? We're gonna have to use all that information in just a minute to solve for some items. And then ABC sold a debt investment with a book value of $3,000 for $1,000, okay? So basically what we're gonna need to do is actually go ahead and make the statement of cash flows. So what we're going to do is that we have all these items, and we're going to go through each one individually, and we're going to determine how to solve for it. Okay, so we have the three-part heading, right? Let's not forget first, if we're doing a full statement of cash flows, we need to make sure that, as with our other statements, we have a three-part heading. So we have the company name, the statement name, and then again, the statement of cash flows covers a period in time, right? It's not just 1 year, so it's for the year ended December 31 of 2018, okay? And so that means that we need to have our three-part heading, and that's what it needs to look like, okay? First, we have our cash flows from operating activities. The first thing is our net income. That was $53,005. Where is that coming from? Well, that's just given in the facts, right? It says net income was $53,500. So we can basically just check that one off. That one is very straightforward. Okay, that one's actually pretty easy. Okay, next we'll see that we have this adjustments to reconcile net income to net cash provided by operating activities. Again, this needs to be on every statement of cash flows you prepare, like basically those exact words. Again, I know it's a lot of words, but you just straight up need to memorize that and know that when you're preparing a statement of cash flows, this needs to be there, right? You need to have net income. Well, first you need to have cash flows from operating activities, but then once you've done that, you need to have net income and then this adjustments line, or I guess it's 2 lines if it's that long, and then you start listing all the adjustments, okay? So the first one we have is depreciation expense. Well, if we look at the additional information, that we just went over, we'll see that, nowhere in here are we given information about depreciation, okay? And so we'll wonder, okay, well, where is the depreciation coming from? Okay, well, we actually have to solve for the depreciation, okay, expense, okay, depreciation expense, okay? So what we would do to solve for depreciation expense is we're going to want to pull this account here, accumulated depreciation. So let's just remember that we have $40,000 as a beginning balance and $50,000 as an ending balance. Those are the two main numbers we need. So what we're going to do is we're going to make an accumulated depreciation T account. A/D is just accumulated depreciation. We're going to start off at 40 and we're going to end at 50. That's what it tells us in the actual problem. Okay, that's what it tells us in the facts on the previous page that we just looked at. Okay, then it says ABC sells a piece of equipment with a book value, initial book value of 30, and then 5,000 of accumulated depreciation. So if you sell something, which is a piece of equipment, right, that would go under the accumulated depreciation account, right? And that a piece of equipment had 5,000 of accumulated depreciation associated with it, which we took off the books, right? Because when we made our journal entry, we'll make our journal entry in just a second to see the entire thing, but when we made the journal entry, we must have debited off 5,000 of accumulated depreciation because we have to remove the depreciation, right? We have to decrease the balance in accumulated depreciation, and the way to decrease the balance in accumulated depreciation is to debit it, okay? So then, once we actually do this whole, once we do the math, we see that depreciation expense is $15,000, okay? And if we flip back for just a second, we see depreciation expense is $15,000, okay? Let's actually make the journal entry for this transaction because it will help us with another piece that we'll need in a minute, okay? So basically they sell this piece of equipment, it costs them $30,000, okay? So they would have a credit to equipment for $30,000. We know that's going to happen. Okay, we just said they're going to debit accumulated depreciation for $5,000, right? They receive cash of $26,000. It tells us that in the problem straight up. Okay, and then now we can see that we have a deficit on the credit side, right? Because we have $31,000 of debits, we only have $30,000 of credits. Okay, what is this going to be? Well, this is going to be a gain on the sale of the equipment. Okay, gain on the sale of equipment. Okay, and the reason I'm writing this whole account out is because, again, on the exam or a quiz or whatever, it's not acceptable to just write gain. Okay, if you're just writing gain or just writing loss, the TA, the professor, whoever's grading it is going to take off points, most likely. The vast majority of them are not okay with you just writing gain, okay, because it's not very specific. There's a lot of different types of gains you could have, and so you really need to make sure you're writing out gain on sale of equipment or whatever the gain is for, okay? How do we calculate this gain? Okay, well, how do we calculate a gain? Well, we figure out, okay, sales price, and we compare that to book value, okay, and then we determine gain loss, right? That's how we solve for a gain or a loss, okay? So the sales price we know is 26, right? It tells us that right there. They sell it for 26,000 bucks, okay? Then the book value, well, that's going to be 25,000. And how did I get 25,000? Well, it's the initial book value, the initial cost minus the accumulated depreciation, right? So it's 30,000 minus 5,000, which gives us 25,000 as a book value, right? That's how we solve for book value or carrying value. Means the same thing, right? Just interchangeable terminology. But that's how we solve for the book value of a piece of equipment, right? We take what we initially paid for it, we subtract out the accumulated depreciation we've actually recorded, and that will give us book value, okay? And so we'll see that the difference is 1,000, right? 26 minus 25, 1,000, easy math. But we know that it's a gain because the sales price is higher than the book value, right? And when the sales price exceeds the book value, we're getting more than what the equipment is worth on our books, right? And so if it's more than it's worth, then that's basically a gain, okay? And we actually will need this piece of information in a minute as well, okay? So then that helps us here as well because we can see that we debit accumulated depreciation, take off the books, we just post it to the accumulated depreciation T account, okay? So as we said, it was $15,000 for depreciation expense, okay? Then amortization expense says it's $2,000. This one, where is this one coming from? Okay, well, we're gonna have to go back to our balance sheet information and we're gonna look right here at the patent account, and we see the patent account goes down by $2,000, okay, during 2018. And really, if you're not told any other information, then if the patent account just goes down, then you just assume that's for amortization expense. Okay? So basically, to repeat, if the patent account goes down and you're not given any other information, the operating assumption is that, okay, that's from amortization expense. And the difference is $2,000 there, right? 72 minus 70 would just be 2,000. So if we go here, we see amortization expense is 2,000. Okay? Then the next, so many accounts, 5 accounts or however many it is, these are basically our changes in current assets and current liabilities. Okay? And we have rules for those. Okay, so we have a rule for how this works. Okay, and so basically this is something you're just going to have to somewhat memorize. Okay, but this is one of the few areas of the class where you might just want to go ahead and just memorize these just because it's a little faster. But basically, for current assets, the rule is that if the current asset increases, then we subtract that increase. Okay, and then if the current asset decreases, we add the increase. We add the decrease. Okay, so you'll see like decrease in accounts receivable. Well, it says that's a current asset, so you add the decrease, right? Then we have an increase in inventory. Okay, increase in inventory, we subtract it. Okay, so that's on the current asset side. The current liability side, if current liabilities go up, you add it. Okay, and when I say go up, if that's not clear, sorry, but basically what I mean is if the account balance goes up from year to year, meaning that we'll see what that means in just a second in concrete numbers, but if it was like 5,000 as of December 31, 2017, and then it goes up to 10,000, okay, as of the end of 2018, that would mean the account goes up, right? Meaning that the balance in the account is increasing versus the balance in the account is decreasing for when it goes down, okay? And then the other rule is if current liabilities go down, we subtract it. So kind of the way that I think about this overall is for current assets, I kind of just do the opposite, right? So if we have an increase in current assets, we're subtracting, right? So if it's going up, we're basically causing this account, on the statement of cash flows, we're subtracting when it goes up, the balance in current assets. And then when the balance of current assets goes down, we're actually adding, okay? But for current liabilities, it goes in the same direction. So if we have an increase in current liabilities, we add, subtract the decrease in current liabilities, okay? So let's just quickly look at these different accounts, okay, and look at the differences. So we don't have to worry about cash, okay? We're doing all current assets and current liabilities except for cash, right? So we're not worried about cash because the whole point of the statement of cash flows is to solve for this change in cash, right? So we wouldn't actually include that in our calculations because that's what we're actually solving for, right? So if we were to say, okay, let's add or subtract this increase or decrease in cash, well, that wouldn't make sense because then we would end up double counting it, okay? So accounts receivable goes down by 10,000, so we know that we're going to need to add that based off of our rule. Inventory goes up by 8. We know we're going to need to subtract that based off of our rule. Prepaid rent, goes down by 2,000. We're going to go ahead and add that, okay? And then, let's see, what else do we have? Debt investments is going to be a long-term, so we're not worried about that. Land and equipment are not current assets. Accounts payable is definitely current liability. That went down by 20,000, so we're just going to subtract that. Okay, unearned revenue went down by 2,000, so we're going to subtract that. Everything else here is either a long-term liability like the bonds payable or an equity account, so we're not worried about those. Okay, so like we just said in the previous page, basically we are going to follow these rules. Okay, so decrease in accounts receivable, like we said, okay, we'll add it. Increase in inventory, we subtract. Decrease in prepaid rent, we add. Decrease in accounts payable, we subtract. Decrease in unearned revenue, we subtract. Okay, and then we have the amounts as well, and they all line up. 10,000 to 10,000, 8 to 8, 25 to 25, 20 to 20, and 2 to 2. Okay, then we have these last couple of things here in the operating section, and we've already solved for the gain on the sale of the equipment. We did that on the previous page. On this page right here, we solved for the gain on the equipment. Now we just need to solve for there's another piece, there's a loss on the sale of the debt investment, okay? So it tells you right here that, so we can go ahead and check off this one. We're basically pretty much, we're almost entirely done with that one. We only have one other thing to worry about. Then they sell their debt investment with a book value of $3,000 for $1,000. Okay, so again, we want to figure out, okay, what was the sales price, and then what was the book value, and then is it a gain or is it a loss, right? So they're selling it for $1,000, has a book value of 3. Well, the difference is 2, right? But it's a loss in this case. And why is it a loss? Well, we're getting less than the book value, right? So we can kind of think about it as we're receiving less than the value of the asset on the books, right? And so in that way, that's basically a loss to us because we're not receiving the full value of the asset. Okay, so we have a loss of 2. Okay, so that's where we get the loss of 2,000. Okay, and we have the gain of 1 from the sale of equipment from before. Okay. So then we have rules about whether we add or subtract gains or losses. So basically gains are subtracted, losses are added. And why does that make sense? Well, again, we have to consider, so within net income, right? Within net income, we would have recorded a gain of $1,000, right? We would have recorded a gain of $1,000, okay? However, when we're recording the sale of equipment, we actually want to record all of the cash flow effects. Everything with that, we want to be in this section of cash flows from investing activities, okay? And so the issue is that within this net income, which is included in operating, we already have $1,000, okay, included in net income. But we don't want anything, right? We want $0 in this first operating activities for this gain on sale of equipment, because we want it all in this section here. We don't want anything up here. We only want it here. So if it starts in our net income, we have to do something to reverse it out. Okay, so if it's a positive 1,000, the way we basically like reverse out that transaction is we subtract out 1,000. Okay, the same thing with the loss, right? The loss would have been recorded as negative 2,000 in our net income. But again, the loss, we want to have $0 in our operating section. Okay, so we have to add 2,000. And the reason that we want $0 is because we want everything from the sale of the debt investment to be in this investing activity section. Okay, so then if we just did the math, we would end up with net cash provided by operating activities of $54,000. Okay, the operating section is definitely the longest, it's definitely the hardest. Okay, and so if you can get that down, the other ones are generally not as bad. Okay, cash flows from investing activities, in this one, it's relatively straightforward. We're told that they sell the equipment for 26, and then we're told that they sold the debt investment for 1,000. Okay, and so basically we just take those numbers of sale of equipment 26, sale of debt investment 1,000, and we get 27,000. So the investing activity section in this specific, sorry, I'm just moving that to get it. Okay, so you can see this at the top here. But anyways, so you can see that this one's not that bad. Okay. Then we just have a couple of things for cash flows from financing activities. Okay, the first thing that we have is a purchase of treasury stock. Okay, where is that coming from? Well, it tells us here that ABC purchases $2,000 of its own stock back from stockholders. Okay, so that would be a cash outflow of $2,000 because they're actually paying out cash to buy these shares back. The next thing says issuance of a bonds payable. Well, if we look on this statement of facts, well, we can see none of these say anything about issuing bonds payable. How do we know they issued bonds payable? Well, we go over to our balance sheet, and we're looking at the bonds payable account now. Okay, and we're seeing that, oh, wow, the bonds payable account went up by 5,000. Okay, the change was 5,000, and it was an increase, okay? And if we're not told any other information, then we assume for bonds payable that we're simply just issuing more, okay? That's our assumption with bonds payable, okay? And like I said before with patents, how do you know what the normal thing is, right? Well, the normal thing is basically like, you know, what could happen without them giving you more information, okay, right? So like with land here, right? Like the land goes up. Well, with land, you know, there's not a ton going on with land, generally speaking. It's kind of like you sell it or you buy it, okay? And so it's like, in that case, they must have purchased land. In bonds payable, it goes up. Well, if they don't tell you any other information, that means they must have just issued more bonds payable. Okay, and so in that same way, like some of it is common sense, but some of it is just sort of like using your accounting knowledge from previous classes and also this class to just logically deduce, okay, what would be something that they could have happen there without giving me more information. Okay, but the bonds payable increases by 5,000, so that makes our cash flows go up by 5,000. Then we have our payment of our dividend. That one's relatively straightforward because it just straight up tells us ABC declared and paid a dividend of $10,000, so that's a cash outflow that goes there. And then we have that's all we have for financing activity, so that's negative $7,000. If we add 54 to 27, and then we subtract away 7, which are this, and this, we end up with $74,000 change. Cash at the beginning of the year was 75, and then cash at the end of the year is 149. So this is where we get to check ourselves, right? We go up here at the top and we determine, did we do it correctly? And the way we know if we've done it correctly is, do we have the right ending balance? Well, we start with 75 and then we end with 149. That's what it tells us on the balance sheet. Well, if we go to the bottom here, oh wow, okay, cool, we have 149. Okay, so now we can check. That's kind of how you can check your overall math and determine whether you've done this problem correctly. Now, is that going to tell you exactly what you've done wrong? No, but let's say that you were off by, $5,000. Okay, if you're off by $5,000, then you probably just forgot the issuance of the bonds payable. Maybe let's say that, you were off by, $26,000. Well, if you were off by $26,000, then you probably forgot to put the sale of equipment, right? And so what you can do is you can sort of troubleshoot. If you're off by a certain amount, you could be like, okay, I know I need to be at 149 because it's going to give you that number. I know I need to be at 149. How much am I off by? And then what would potentially get me to that number? What would potentially get me to the 149? Okay. Then the last thing that we have is that the problem tells us that the firm issued $30,000 of common stock in exchange for a piece of land. And again, we said that was non-cash financing and investing, so we just have it at the bottom here. Purchase of land through issuance of $30,000 of common stock. Okay. And if we flipped back to our balance sheet, this is the last little thing, we can actually check and make sure that makes sense. Okay, so common stock went up by 20, additional paid-in capital went up by 10. So this is a total change of 30, right, which corresponds to this change of 30 up here. Okay, and so that's how you can kind of check and make sure, oh, okay, yeah, that does make sense because this went up by 30 and this also went up by 30. Okay, so basically that's it for this problem. It's a pretty extensive problem, but it is very helpful to be able to, you need to be able to prepare this from scratch. You need to be able to, have it properly formatted with indenting and things of that nature, making sure that, you're dividing up the sections properly. You have the 3-part heading, everything like that. And then if there's any non-cash investing and financing, you need to have those as well. So that's basically everything for the statement of cash flows, and that's the end of this video.